In this video we are going to talk about utility dividend stocks. So before starting, please like this video and subscribe to this channel for our future updates. It may seem unusual to be talking about utility investments during a period of rising inflation, but that is exactly what we are doing. After all, while their revenue is typically consistent, their costs can fluctuate significantly. The sector has outperformed the market despite this, losing only 4% over the last 3 months compared to the S&P Wink with tongue sticking out 500's over 10% decline. They also pay dividends, and they're quite good dividends at that. Morningstar researchers indicated in a study published on January 26 that utilities continue to be one of the few viable options for income investors. It is noted that the 3.2% dividend yield on utilities has traditionally been excellent in compared to interest rates, giving investors with ample yield protection even if interest rates rise in the future. Dividends, on the other hand, are not everything, and it is sometimes preferable to invest in a utility that pays a lower yield if the firm is stronger. 8 dependable utilities, along with their respective payouts, are listed below. Number 8. Pinnacle West Capital Corporation, PNW. Despite the fact that its stock was trading at roughly $68 per share as of Wednesday's closing, it was still much below Morningstar's fair value estimate of $77, and analysts expect it to rise even further. Additionally, in addition to the chance of share price appreciation, the company pays a large dividend yield to its owners, which is now 4.9%. The company's headquarters are located in Arizona, which is one of the nation's fastest-growing states in terms of population growth, as well as one of the most economically affluent states in the country. Pinnacle's electric service will witness an increase in the number of consumers as a result of an increase in the number of families and commercial businesses. Forecasts indicate the company will spend a total of $4.7 billion between 2022 and 2024 on transmission and distribution infrastructure, as well as on generation assets in that time period. A total of $560 million in total expenditure is attributed to the renewable energy industry, which accounts for the lion's share of overall expenditure. Number 7. NiSource Incorporated, ticker, NI. According to Morningstar analysts, increased consumer spending, supply restrictions, and rising energy prices are all contributing to greater inflation, but they believe this is only a transitory event and that inflation will return to normal soon. Because of attractive dividend yields and infrastructure growth, utilities, according to the authors, are well positioned to generate another year of total returns in the range of 7% to 9% if interest rates can be found in a sweet spot that keeps inflation under control without alienating income investors. Because of regulatory support and investments in the company's plan to transition away from coal and toward renewable energy sources over the next 4 years, analysts predict that NiSource will see an increase in earnings of 8% each year for the next 4 years. Number 6. Edison International, EIX. Edison International's management increased the company's dividend by a percentage point for the current fiscal year, and Morningstar anticipates that this trend will continue in the future. The company's electric-only operation, recent regulatory victories, and billions of dollars in planned expenditures, according to industry analysts, would result in average profit growth of 6% over the next 5 years. They claim that Edison provides a triple play of value, growth, and income. They go on to explain what they mean by this. According to Edison, the company's efforts to protect the system against natural disasters, integrate renewable energy sources, invest in utility-scale energy storage, and promote the use of electric vehicles have garnered support from stakeholders in California. The analysts also believe that Edison International is trading below its fair value estimates, in the same way as NiSource is trading below its fair value forecasts. Number 5. Entergy Corporation, ETR. Even though Entergy has been behind its peers since 2020, Morningstar analysts see 3 big advantages for the utility: a growing service area, constructive regulation, and a lot of room for growth in renewable energy investments. According to experts, it is likely to get $4 billion in investment each year through 2025 in order to upgrade its large grid and replace coal-fired power with mostly solar power. This contributes to our annual earnings growth expectation of 7% to 9%, which is at the top half of management's target range, says the company. According to the opponents, the utility should be given the authority to raise consumer prices in order to cover higher financing costs for investments in renewable energy, among other things. Number 4. Nextera Energy Incorporated, NEE. As a result of increasing project economics, tax breaks and more efficient panels, Morningstar analysts expect that solar output will overtake wind energy by the end of this decade. They cite extensive use of battery storage as one of the primary reasons for their prediction. Nextera Energy appears to be one of the winners of this, as the company has garnered accolades for its solar operations in Florida, as well as its investments in battery storage technology, all of which have received positive feedback from analysts. As multiple analysts have pointed out, a stock market sell-off in January has decreased the premium value of Nextera's stock, but the granddaddy of U.S. renewable energy has no intentions to slow down. Constructive regulation in Florida generates industry-leading returns and growth, according to the governor. Number 3. Duke Energy Corporation, DUK. Morningstar experts feel that higher interest rates may even be beneficial to utilities, since they minimize the likelihood that regulators will reduce the returns on investments that they permit from power-producing firms, which would otherwise be detrimental. Utility companies also have a wide range of investment options to help them offset the earnings pressure caused by increased interest rates by diversifying their portfolios, which they can do by using a variety of strategies. Approximately $60 billion in capital projects are expected to be invested by Duke Energy over the next 5 years, paving the way for earnings growth of approximately 6% per year in the future years, according to analysts. The company's operations will be made easier, according to some, because of favorable Florida regulations and new North Carolina legislation. Number 2. WEC Energy Group Incorporated, WEC. Regulatory frameworks at the local level have an impact on utilities, but they are not the only ones. According to analysts, federal policy is also crucial, and the federal government will continue to support utility investment plans, particularly those involving renewable energy sources. Following an investment plan to replace coal-fired power plants with renewable energy generation paired with favorable legislation in Wisconsin, analysts expect WEC Energy's annual profits and dividend growth to be in the upper half of management's goal range of 6% to 7% in 2019. Although WEC Energy's stock is trading around Morningstar's fair value estimate, analysts point out that the firm, like rivals Nextera and Duke Energy, has growth and regulatory backing that meets or beats peers with similar premium values, according to the analysts. Number 1. American Water Works. AmeriWater Works, the nation's largest publicly traded water and wastewater corporation, has a market value of $17 billion and a market capitalization of $17 billion. The majority of the company's revenue comes from regulated water and wastewater services, with the remainder of its money coming from less predictable market-based operations, such as supplying water-related services to households and the military. AWS intends to grow its earnings per share, EPS, at a compound annual rate of 7% to 10% over the 5-year period from 2021 to 2025, making it one of the nation's fastest-growing utilities. Among the factors contributing to the company's optimistic outlook is a multi-billion-dollar investment program to expand its regulated commercial operations. A strong financial profile allows the water firm to fund its expansion objectives with the financial flexibility that it requires. It has an A rating from the credit rating agency S&P Wink with tongue sticking out Global, NYSE, SPGI, making it one of the few utilities with such a high credit rating. Meanwhile, the company maintains a very conservative dividend payment ratio. It has set a target of 50 to 60% of adjusted EPS. American Water Works' strong financial foundation. The company expects to grow its dividend by 7 to 10% per year through 2025. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.